This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart book, which is titled Exuberant Markets. Talk about an understatement with this week's stock market action. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, then by all means, go to our homepage, macrovoices.com, sign up for it by clicking the red button that says Looking for the Downloads. Patrick, Chart 2, Bitcoin versus U.S. dollar. Well, boy, that's a little bit of a scary looking, maybe the beginning of a blow-off top. What do you make of this chart?
Well, I think back to when we were doing our episode of Macro Voices back in late 2017, early 2018, when we had the original top. And one of the things I shared with listeners at the time was that when things go into their parabolic phase, where everything is so frothy and everything is just going up at thousands of points every single day, the one thing that the market inevitably has a date with is some sort of mean reverting correction. It's just gravity takes over something that's going up that quickly. And what we have is a scenario where we have the exact deja vu of that. I mean, through late 2020 into this first few weeks of January, Bitcoin went full on parabolic. And this is, we don't even have to have an opinion as to whether the merits of Bitcoin itself, just purely the technicals and the behavior of price. And this applies to any and every market that goes into the same type of a parabolic rise. And one thing we were just asking and over the last 2 weeks was, when do we finally see the blow-off tops in both Bitcoin and, in the case, Tesla? And I think it's very important to identify, because I think it will shift sentiment that could actually ripple into the broad markets. And I think that they're sort of like the generals of this bull market. And what's interesting is, even though Tesla has stalled, and I don't have the chart of Tesla here, it hasn't really begun correcting. But Bitcoin, on the other hand, has. And we've already seen a considerable correction. But what was the big warning sign to me was not that it had that 3-day market correction where we saw Bitcoin, drop. There was that 20% down day that it had in just one day from top to bottom of the move. But I always say it's not about the sell-off, but whether or not the bulls are capable of breaking it to higher highs. And what we had was a rally back towards 40,000, and they failed to break it to higher highs, and we're right back down to those lows that we saw several weeks ago. And this is now showing the behavior of distribution. And what I circled there in red, if we go to page 3 and page 4, where I have the circles, you see a similar style pattern, which is once the parabolic rise finished, there's a second attempt to rally and break to a higher high. And when it fails, it turns and begins a distribution cycle. And we saw that back in 2019 in the summer, and we saw it again in 2000 and the original big top, which was the 2017-2018 peak. And each time Bitcoin began a considerable and quite deep mean reverting correction of its excesses. And I just asked the question, have we just seen the short-term high in Bitcoin? And I mean, at this point, it's using the analog of those. It really does look like the same type of pattern. And it'll be really interesting for us to track in the next couple of weeks whether that analog continues to develop that way.
Well, Patrick, there's also some fundamental news that has affected this tape. So let's talk about this next. And I'll go back to page 2 in the slide deck where we're looking at the current move. As you say, there was just a parabolic rise that was due for a blow-off top anyway. So this could be just a technical move. But the thing that occurs to me is, what might have brought about that sudden reversal where it was just straight up to straight down? Well, that happened about 4 or 5 days before Christine Lagarde made her comments that she basically was calling on all central banks to aggressively regulate Bitcoin. It makes me wonder if somebody had early access, inside information that was coming and started trading it. So that was something that was kind of a question in the back of my mind anyway. And sure enough, right around the time that Christine Lagarde actually made that statement, it became a sell the rumor, buy the news kind of event where we started to rally again, and it seemed like the market wanted to recover. But then there was another very sudden reversal to the downside that just happened in the last week or so. Well, what might be driving that? The news that's come out, and frankly, I don't follow cryptocurrency stuff that closely, so I'm a little bit out of my lane here, Patrick, but I do want to provide our listeners with at least some background information as to what's going on. You can draw your own conclusions. The news that's come out has been an analysis. There was a couple of articles that have been published where people have said, look, what has been driving this huge rally in Bitcoin over the last several weeks as we've doubled in price? It's not Bitcoins being purchased in US dollars or being purchased in Korean won or being purchased in Japanese yen or euros. It's Bitcoins that have been purchased with Tether, with another cryptocurrency. Okay, what is Tether? Tether is a stable coin. The sales pitch for Tether says what that means is that it is backed. Every single Tether token is backed by a US dollar that is on deposit in a bank. Therefore, it is basically guaranteed that that stablecoin, hence the name stablecoin, will always be redeemable for $1 worth of value. It's supposed to track the value of the US dollar so that it doesn't go up and down in price, but it's a reliable store of value because it's backed one-to-one by good old-fashioned US dollars on deposit. That's the sales pitch. The internet rumor mill, and of course the internet rumor mill is subject to its own forms of manipulation, but what people are starting to allege, and I frankly have no way of verifying or proving or disproving this, is that Tether is a giant Ponzi scheme. They supposedly have backing dollar for dollar. Every token has a dollar behind it on deposit. Where is it on deposit? Is it Chase Manhattan? Is it Citibank? No, it's Deltec Bank in the Bahamas. And everybody knows that financial scams never happen in the Bahamas. So the backing of Tether is dubious, to be sure, and people are starting to allege that what's going on here is Tether has been printed somehow where there's not really a dollar behind it. There's a whole bunch of essentially phony baloney monopoly money Tether that has been used to prop up the price of Bitcoin, and the scam has just been revealed. Now, I don't know whether any of that is true. The point is, that's the latest rumor that's circulating. There have been several articles written about this. Frankly, my position on cryptocurrency is I ignore all things crypto to the maximum extent possible. So I really have no idea whether Tether is a scam or Tether is completely legitimate and it's scammers that are saying it's a scam. I don't know, but I am convinced that what's going on is this fear, uncertainty, and doubt associated with Tether has resulted in this next knee-jerk down. The market's going to decide either whether that's a real problem or just a fantasy problem. And I think the real question is either Bitcoin moves to yet another fresh high in the next few weeks, or it's probably done for quite a while. So I don't think that the final tell is in. I'm leaning towards it's done for a while, but I think we need to wait out the next couple of weeks. As a technician, based on those fundamentals that I described, what would you say in terms of what are the signals that you watch for to get confirmation as to which way this thing is headed next?
Well, the pattern of distribution essentially is that all rallies now get sold. So there will be periods where we will see, a $2,000, $4,000 rise, maybe even more. But the pattern that really shows that this has turned the tide is that every rally starts being sold and distributed as smart money is realizing that the gig is up, and it really starts to make sure that they try to unload as much as possible at the highest prices they can. And so that one thing I'm going to just be watching is whether that pattern persists. Like there's still a chance that this is just a Fibonacci retrace and we find support above 30,000 and the bulls just find a new catalyst to lean on and break this thing to all-time highs. It's possible, and that's sort of the art of reading the tape and seeing how it develops. I think that we shouldn't see prices above like 36,000 if in fact this is a topping formation. Maybe a quick little poke above there temporarily, and then but if we stay below there, it's going to increase my conviction that that top is in.
And again, I have no way of knowing whether this tether story is real or not real. But boy, if it is real, and what's really been propping Bitcoin up has been purchases of Bitcoin with monopoly money that everybody assumed was backed one for one by US dollars, but it really wasn't. There could be quite a bit of downside if that is actually proven true. I have no idea if it is or it isn't, but it'll be interesting to watch, to be sure.
Anyway, so moving on to page 5, I just wanted to talk the S&P 500. We already in the last couple of weeks talked about the progressive rally of the S&P 500, but really that isn't where the bubble in equities is occurring, right? We were talking about those other sectors within the markets where all the parabolic rises are going. Even the auto industry is going through this huge parabolic rise at this moment. So the S&P is doing its crawl. There are targets up to 39. 900, even one target that measures out to 4,000 on the upside on the S&P. And so there's room for the S&P to crawl higher here in the coming days and weeks. But what is amazing is just some of the warning signs that we're seeing that typically are associated with the froth that comes along a short-term market top or even an intermediate market top. And what is interesting is on page 6, I have a chart of option activity. This one is a chart that was provided by Spot Gamma. Brent over there did a great job putting together this chart. And what this is showing is looking at the amount of options that are bought to open minus the ones that are sold to open. And so it's looking at how retail and institutional investors are positioning themselves with options. And the blue line is showing equity call options. And this ratio is making a fresh new high, which is showing that there is a lot of froth about buying call options and buying gamma to the upside of the market. So in general, you have all of this energy that's coming where dealers are going to have to literally be buying equity and futures in order to keep themselves delta neutral while all the call buyers continue to press the upside. But what is also interesting, which is circled in red, is the fact that for put options, we are now seeing that ratio has turned negative, which means there is a much more interest to sell options for premium to open than there is to buy those puts as insurance or protection from a market drop. And we saw this conveniently also below zero back in January, just a month before the market turned for the coronavirus decline crash. And we saw the same circumstances back in August before the last short-term market top. Now, there's no guarantee that this is going to lead to a market crash or some big liquidity event, but a lot of those characteristics that showed this kind of option activity along the last two highs is all here right now.
Patrick, you've got a couple more sentiment charts on page 7. What kind of sentiment are these things measuring?
The one on the left is the one we shared last week that Charlie McElligott had out there talking about just how the different readings at Numara were at extreme sentiment. But there was an interesting chart that was put out that's put together by Haver Analytics and Citi Research. And it's the panic euphoria model, and that shows just how much froth is in there in terms of the 12-month forward return on investment. And what you can observe here is that we have now hit such a euphoric overshoot that we have now exceeded, based upon this calculation, the euphoria of at the 1999-2000 peak in the equity markets. I never thought we would see us reach these kind of euphoric levels, but here we are having exceeded them. And again, that doesn't guarantee that a market decline has to start imminently any day, but it really does show how everyone has really gone all in on this, and the belief that Yellen and the Fed will just continue to keep this party going with more and more liquidity to keep driving the trend. I asked the question, what could possibly go wrong, Eric?
Well, I don't think there's any easy calls here, Patrick. You would think normally, if you showed either one of us these charts, 5 years ago and said, what if you got to a point where sentiment reached these extremes, even greater than 2000? You'd say in a heartbeat, obviously, it's time to short the market. It's about to crash. It's way overdue. The thing is, we've never had a time in history when this kind of unprecedented central bank stimulus and monetary policy intervention was being contemplated. And if there's anything that the market's proven to me in the last 10 years, it's when they print enough money, it has to go someplace, and it usually goes into financial markets. So it seems totally crazy to think that the market still has a lot of upside left in it. But I don't dare short it, and I'm not frankly all that excited about being long either. I think it could go either way.
Well, one of the things where I'll push back a little bit on is if we move on to page 8, and it shows the margin debt and really how much the borrowing in the market has increased. And the reason looking at how much margin is being utilized in the markets, why it's so important, is that that's the part of a portfolio that is renting the upside. Because during a liquidity event or some pullback, often it's the margined parts of the portfolio that have to be liquidated, and it's forced selling that could draw and create that negative feedback loop that just feeds a market decline. And the fact that we are seeing, especially at these incredibly low interest rates, more and more investors continuously tapping margin to leverage up that upside, that is really, I would argue, the fuel that could create the volatility. Now, again, we don't need to be calling a bear market, and we don't have to be calling, some devastating crash like a repeat of March of 2020. But whenever we have these types of excesses, if any trigger creates a sell cycle, the fact that we are so leveraged up on margin and things like this in the broader market, that adds fuel to creating that very volatile correction that could happen on the other side.
Well, Patrick, we're going to need to leave it there for this week's episode. Listeners, if you want to follow Patrick's play-by-play on this, sign up for a free trial of Big Picture Trading. You can find the information on slide 9 of the deck or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.